reflected twice in the balance sheet, either both times on the asset side or once in the asset side, once in the balance sheet. So let's give it a try to see whether you really understand this principle. Let's say a company used its cash to buy new equipment. What changes would we see in the balance sheet as a result of this? Yes?
Cash decreased.
Cash decreased, yeah.
Equipment increased.
What does increase?
Equipment.
Equipment. Equipment is part of, yes, assets, but which part?
Non-current.
Long-term or non-current assets. So that's an example of a transaction where just assets are affected, but one is with the plus side, that's your long-term assets increased. Another is with the minus side, your cash decreased by the same amount, right? Let's try another one. You have taken a short-term loan from a bank, the one you need to pay back in 3 months.
Current.
The question is again, how would that be reflected in a balance sheet if you have taken a short-term loan from a bank?
Current liabilities.
Current liabilities increased.
Cash will go.
Well, what? Cash?
Will go up.
Cash increased as well. Yes, yes. So this is an example of the active-passive transaction, so-called. So your assets have increased and your liabilities have increased by the same amount. Right? So if both sides of the balance sheet are affected, the sign is usually the same. Here we have increase in assets, increase in liabilities. If just one side is affected, then you would be having opposing signs in order to sort of cancel each other out, so to say. So again, you've seen it before, but just to remind you the components of a balance sheet, what it consists of. So we have assets that consist of non-current assets and current assets. Non-current are those that we are usually intending to hold for longer than a year. So if we bought some equipment, hopefully it will serve us a few years, right? So that would be a non-current or long-term asset. If we have some cash, which we can spend anytime, or we have some inventory, which we will be selling off within the next couple of months, then that would be a current asset.
Sorry, are we going to have to do any calculations or any exams? Do we get formulas that we have to remember?
The formulas you have to remember. Yeah. If it's any consolation, the ratios, I recognize that there have been a lot. I'm going to put on Blackboard a sheet which covers, I think, about maybe 10 to 15 most important ratios. Still a lot, but that's less than the number we've looked at. Yeah. But also the good news, which I have mentioned last time. Last time some people said, last year some formulas were given, yeah, in the exam. And I did look at that. The thing is that the formulas they've got are more complicated than what we have covered. So they weren't given all the formulas, just the most complex ones, which I haven't even been teaching you because I thought it would be too overwhelming. So don't feel bad about having to memorize the formula. I guess what I'm trying to say is that it's normal. It's not that.
I think last year, people that took this module, they had like they had a choice either between two where they had like write a short essay or one calculation, and the two calculation, one kind of short essay.
you weren't here last week, were you?
No.
Because I did speak about the format of the exam, but let me repeat it just for the benefit of people who haven't heard. So the format of the exam, there are two parts. The first part contains 6 questions, and all of them are mandatory. 5 of them are numerical questions, and they're relatively short compared to what was last year. Because last year they had a really big, extensive numerical problem, which one encompasses basically many sub-problems. Here you have more, but they're all shorter, taken individually. Then the 6th question asks you to define some concepts that we've covered in the module. Just short definitions expected.
How many?
I think that there are about 5. But it's basically you're writing to a couple of sentences for each of them. So that's part 1. And then in part 2, you are given 3 open-ended questions, out of which you need to choose 2. So there is a bit of choice.
So what's in open-ended is kind of more kind of essay?
Yes, essay types of questions. And again, I think we digressed a bit, but since we're off the topic anyway, let's talk about it now that the issue has been raised. I think there is some anxiety about the open-ended questions, essay types questions. There was this anxiety during the assignment, and I think many people still have it. So I just want to discuss a bit some of the strategies you may want to use when tackling open-ended questions. So just to make sure there are no recipes as such, because there are so many ways in which you can approach each essay question that it wouldn't be either feasible or sensible to try to tell you that's what you're supposed to write and that's not what you're supposed to write, because there are numerous ways. Nevertheless, I think some of the approaches could be helpful. Such as make sure you have an outline before writing anything. You don't necessarily need to start with it, because some people like to plan it out at first, have an outline, and then write. Some people want to be a bit creative and messy, so at first they write everything that comes to their head about whatever question, then they read through their notes, say, okay, let me try to make sense of it, and then out of some of their ideas they have brainstormed for themselves, they create an outline at a later stage. But regardless which way you're doing it, I think at some point it's useful that you have it. So you may want to start doing a draft and be really messy, but once you are really writing an essay that you want to submit, know what you want to write. There should definitely be an introductory kind of paragraph in your case, because it won't be huge essays, so it will probably be just a paragraph or 2 where you need to basically set the scene a bit. And what do I mean by setting the scene? First of all, you may want to demonstrate that you really understand what you are being asked here. So you may write some opening sentence that would either talk about the importance of this problem, or you are just rephrasing the question, but in the words that make sense to you. And by saying that you've rephrased it, you framed it, the reader can see straight away that you sort of know what you're talking about. And then it's also a good idea to guide your reader a bit in terms of what will this essay contain. So you may say, this is what will be discussed, and this is what I'm going to argue. Right? So you're sort of giving a bit of the roadmap about what you're going to write. Then you have the main body of your argument, but please don't write body, because in one of the assignments I have received the submission which said introduction, body, conclusion. It really made my day. It was very funny, but I wouldn't recommend doing that in the exam. Yeah. So it's just for you. You know that this is the main body of your argument, but don't write the word body. And then it's for a short essay, and your essays in the exam will be short because you won't have time for long ones. It's a good idea to have probably 3 or 4 main points. So decide for yourself what exactly you're trying to say on this topic. Because again, having read through your practice essay and having read through your assignments, I have seen a lot of quite unstructured answers where people just write whatever comes to their mind on the topic, and there is no particular logical order or coherence. What you want is to make several points. So I think 3 probably is a good number for a short essay. So again, you don't need to call it point 1, point 2, point 3, but decide for yourself what are the 3 main ideas you want to communicate about this topic. And also use signposting. What I mean by that is guide your reader a bit. So say first, second, or next I'm going to argue, or from the previous point what follows is. So things like this, which helps a reader navigate through your text, because when you're just jumping from one point to another, it makes it very difficult to read, and the impression is just wrong. Like you don't know what you're talking about, even if sometimes it's not necessarily the case. You're just not doing justice to your ideas by omitting that. Yeah. So develop those 3 points, and then in conclusion, summarize them, reiterate them, and try to relate back to your introduction. So for example, if in the introduction you said, that's the question which I'm going to answer, in the conclusion make sure that you have summarized what this answer is. Also, don't introduce any new material in the conclusion. Again, this is the mistake I've seen in some of the submissions, when people all of a sudden introduce new arguments. So they've spoken about some, for example, let's take this topic of your assignment, the risk-free rate. So they've given some ideas about alternatives to US treasuries. So let's say looked at the government securities of other countries, at corporate securities. Then in conclusion, all of a sudden they say, well, also gold is another good alternative. And I'm like, right, where did this gold come from? Because it wasn't mentioned before. In conclusion, you don't expect to see any new material. It's just the summary of what was done before. So these are the basic rules. Now, because you're writing on the spot without referring to the literature, I don't expect you to have proper references. But knowing at least some key names, such as Miller and Modigliani, for most corporate finance topics. So if you're discussing dividend policy or optimal capital structure, I would expect at least some mention. Also,
Miller
Modigliani.
So,
But
mention in the test or just at the end?
No, you don't need to give the full bibliographical details. But if you just mention, as Miller and Modigliani in parentheses 1961 argued, yeah, then that would be helpful. Also, if you have read something on the topic and you remember where you've read it and who argued that, if you just again give the name of the author and the year, that's very helpful, because although it's not mandatory, but it really shows that you have read widely, that you have thought about the topic, that you have studied it, and it's not like this is the first time you have encountered it during the exam. So therefore, references are good. That's what I'm trying to say. How many of them to put, whether to put them, I don't really insist, because I can perfectly imagine a situation that he would write a very good essay without any references. But if you can, that would be a good idea to include them. Yes.
So what kind of topics should we expect in these kind of open-ended questions?
Any topics that we have covered in the exam. And again, the goal would be to test your understanding and thinking. So again, those topics are not necessarily about some specific right or wrong answers. Just have you read, have you thought about those issues, have you understood them? That's really what they're about. And just generally, how can you develop your ideas? How can you think on your feet, as they say? That's the goal. And also, I know that some of you have been finding the numerical problems somewhat difficult. So it's a chance to get some extra marks if you don't like maths, but you just understand the concept and prefer to talk about them in words. Then this is again a chance for some people to get extra marks. For others, it could be the other way around. Some of you could be much more comfortable with applying specific formulas, but then again, there are enough marks reserved for that. So I think it's a balance where you can do reasonably well, even given that there will be different learning styles, different levels of prior knowledge of finance and related subjects. Any more questions about the exam or the open-ended questions before we move on? I've been just talking about tackling essay types of questions in the exams. Yeah?
It looks like the exams is going to be hard. It looks like it's going to be hard.
Of course.
It will be hard. Studies are hard, right? Especially if you try to learn something. Okay, let's move on then. But if you think of something else you want to ask, then we can always come back to it. So we've been discussing the structure of the balance sheet. As I said, the assets consist of non-current assets and current assets. And then liabilities equally consist of non-current liabilities and current liabilities. Current are those that you need to pay back within a year. Non-current are long-term liabilities. Profit and loss statement. It shows us how much we have sold and made money. So it shows our sales in monetary terms. It shows our expenses and also interest, income, and taxes that we need to pay. Does anyone remember why a company can be profitable and yet run out of cash? That's actually an example of a potential open-ended question. Not that you're going to get this one, but something like this could be asked. Why?
Because they can have it in assets.
It doesn't have much cash.
Yes, but it made sales. It made sales. It sold more than it spent in its costs, so the company is profitable. How could it run out of cash and even go bankrupt? Because profitable companies.
Sales might have been on a credit.
Okay. Yeah, that's one important factor. So
more loans.
Remember, we were discussing some mismatches between what we see in our profit and loss statement and what we see in the cash flow statement. So profit and loss statement shows how much we have sold, but some of it could be on a credit. Then also what costs we have, but again, maybe we have very good terms with our suppliers and we then don't have to pay them straight away. So that's another potential mismatch. And there is at least a couple of more important distinctions which I'd like you to try to remember. Okay, let me ask you it in a different way. What do you often see in the cash flow statement? It's a cash outflow, quite a big one, that you won't find in the profit and loss statement.
Loan payments.
What?
Loan payments.
Loan repayments. Yes, that's one of them. Indeed, in the profit and loss statement, you would only see the interest payments. You wouldn't see the repayments of the loans. Yep.
Dividend payments.
There is another one that I had in mind though. That's a good point, but not what I was asking for.
Dividend payments. I don't know.
Excuse me? Accruals. Okay, yeah, but again, not what I had in mind. Okay, let me give you a hint. When you say purchased a building, what happens? Where does it get?
Depreciation.
Depreciation, yes, but straight away you purchased a building. In that year, what happened? What happens in the statements? The cash flow, yes, you have a huge cash outflow
Yes,
because all the cash went out.
but it comes to the assets. If we look at that,
It comes to the assets, yes. Yeah, you have cash out, assets up.
yes.
So that's an active transaction. What happens in the profit and loss statement?
It comes as expenses in a profit and loss, purchasing the building.
What, the whole thing?
No, maybe the electricity or
under the company, they usually like if they will purchase something, they kind of go like they divide it over the 5 years kind of thing.
Depreciation.
Indeed, it would be reflected as depreciation. Yes, it is one of the costs, but it's not incurred in the same year because this is a long-term assets and this building will serve us probably 20 or 30 years. Therefore, we would not include everything in the expenses for this 1 year, right? We would instead spread this sum over those 20 or 30 years. Therefore, only 1/20th would appear in the profit and loss statement under depreciation.
If you purchase machinery, for machinery, obviously you're not counting 10 to 20 years, it counts like let's say 3 to 5 years.
Yep.
Something like that.
Yep. For the machinery, the term that we would use them for, it would be much shorter, but it's the same principle. So you have this huge cash outflow straight away, but you have the depreciation, which is just a fraction of the total sum. So I hope you understand those sort of basic things about the financial statements because they're just really a foundation of many of the things we have looked at later.
Is that a bit, is that earning before interest and tax?
Yeah. It's the same as operating profit.
And what is the difference between the EBIT and EBIT margin?
EBIT margin is in percentages. So EBIT is in the currency, dollars, pounds, whatever you have. EBIT margin is your EBIT over sales expressed as a percentage. Cash flow statement we have looked at. Before we move on to looking at the ratios, I'd like to ask you a different type of question. So, as a financial manager, what's my main goal is, by the way? Again, that's from week 1, that was long ago, but still.
Fine. What is the main goal?
What's my main goal? What am I supposed to do? What's my job? What is my job about?
To increase the
Yes, I need to maximize the wealth of my shareholders.
Budget
That's the understanding of what I do.
Decide if what is paid dividends or select on project.
These are some specific tasks I need to do, but my overall goal, the reason I'm in my job, is to make my shareholders better off, right? But let's say that I want to choose a particular supplier because he's being really nice to me and he will take me out for an expensive dinner.
No, really.
What kind of problem does it represent?
Agency.
Yeah.
I think
Does everyone remember what it is? The agency problem. That's I just have had a slide about that. Again from week 1. But this is a problem which occurs when managers take decisions which are not in line with the goals of the shareholders. So it's not in the best interest of the shareholders for me to choose this supplier just because he's taking me out for expensive dinner, but as a human, a manager may be tempted to do so. So that's actually another example of a potential and quite suitable essay topic. So you're asked to discuss. And if you're given such a broad topic, there are so many things you could write. So you could explain what it is, but then you could explain how, in particular, this kind of problem can manifest itself, and what are some of the things that shareholders can do to make sure that manager is doing his or her job. And then, if you have read about it, you could discuss any of the specific examples that you have come across and so on. But the options are really limitless. And that's exactly the reason why I can't give you a specific structure, because there are hundreds of ways in which you could structure an answer to such a question. We have also discussed that the agency problem doesn't necessarily arise just between the manager and the shareholders. It can arise between various combinations of stakeholders, because you can also have a conflict. Really, agency problem is about the conflict of interest, right? And the conflict of interest could come from many different directions. So you can have a conflict between the interests of manager and employees, between the customers and the company, potentially, and so on. So again, these are other possible directions in which you could take such a topic if you were to receive such a question on the exam. Now, let's get back to our financial statement analysis. So, ratio analysis, what is it for? Why can't we just look at two balance sheets of two companies and compare them directly? Why do we need ratios?
To assess the company's financial position and compare perhaps with the previous year, but also with the similar companies within the industry, but also within the sector
Yeah.
which this company operates.
Yeah, my question was just why do we need ratios? Why can't we just look at two balance sheets?
Not comparing the companies with each other to understand that which company
Yeah.
is more profitable.
It's much easier to look at the ratios than to try to compare the balance sheets or profit and loss statements, because you can have companies of different size and just looking, say, at the absolute size of the profit doesn't necessarily tell you very much. So if I tell you Okay, my profit, or not my, but profit of the company A for last year was 10 million pounds. And profit of the company B was 30 million pounds. No, I'm just giving you an example. So we have two companies, and one is 3 times as profitable as the other. The question is, do we definitely prefer company B, the one who, or we need to know more?
Need to know more.
We need to know more. For example, we may want to know what the sales are, because the smaller company, the company A, who produced just 10 million profit, maybe the sales are just 20 million, and it delivers 50% return, which is fantastic. And the company which produced 30 million profit, maybe the sales were 300 million. So it's much less profitable on that basis. Therefore, ratios are good because they let us compare. They are easy to understand, and creating benchmarks, as you said, is much easier on the basis of ratios than if we look at absolute numbers. Ratios are falling into 5 main categories: profitability, activity, liquidity, gearing, and investor valuation ratios. We have covered them all, therefore right now I'm not going to spend time looking at all these categories. But as I said, I will put together a file and put it on Blackboard, and just mentioning which ones are the most important, and those you would be advised to really remember. But just to remind you, several ratios from the liquidity category. We have the 3 main ratios: current, quick, and cash ratio. So in all cases we have current liabilities in the denominator, but then what we actually have in the first part of the equation differs. So the current ratio compares current assets to current liabilities. The quick ratio excludes inventory from current assets, and then the cash ratio looks at how much cash we have in relation to the current liabilities. So I've included a problem again from one of the early lectures. I think there is no need for us to spend much time on it now, but let's look at it briefly. So if we were to calculate all these ratios, where do we find, how do we calculate current ratio based on this data? So current ratio is current assets over current liabilities. Yeah.
Sure.
Where do we get current assets?
From
The
the
total is
balance sheet.
65
Yeah.
million.
So these are our current assets, these are our current liabilities. We just take it from the balance sheet, divide one over another. For quick ratio, we would just look at these 3 items. Cash, short-term investments would also be included there because they are very liquid. And quick ratio looks at sort of more liquid part of the current assets. Inventory is somewhat less liquid because it takes time to sell inventory. But having cash in the bank account or short-term investments that we can easily sell, that's still liquid. And that's why it's called quick. It's like the things that we can quickly convert to cash. Yeah?
What about the other current assets?
Other current assets, it's best not to include it because we're not sure what they are. Maybe they're not that liquid after all, and we want to just include the quickly convertible assets. And then we have cash. So which we would divide in all cases of our current liabilities to calculate quick ratio.
You mean cash short-term investment and accounts receivables, adding all together.
For quick ratio, yeah. So here I have it written down. So quick ratio, we have taken those three items here: cash, short-term investment, and accounts receivable. But we left out inventory, we left out other current assets for calculating the quick one. And for calculating cash ratio, which is just cash over current liabilities, we just take cash here. Is it clear, or
Yes.
there are
Yes.
any questions on this?
No.
I think it's quite straightforward.
So is it going to be loads of ratios you
There will be some ratios. I can't tell you which ones. So what would you say about the liquidity of this company?
It's deteriorating.
Yeah, it's written here. But if we ignore the fact that it's written here, what can we say about it?
What would, like, for instance,
The ratios have decreased
For the first
what would go-
year on year.
Sorry, several people were speaking simultaneously.
What would be the norm, for instance, like, if you would use cash ratio to determine liquidity, would you go like over one or like?
No, you won't be asked about the norms, because as we have been discussing, what is acceptable really varies depending on the industry. It really varies. Therefore, when I first learned those ratios, I remember in the financial management course that I took years ago, we would be given norms for some ratios and made learn them, which I think is completely ridiculous, because the norms will vary so much that it's just useless to try to learn them and then use as any kind of benchmark. But by looking, if you start specializing and you start analyzing a particular industry, you will soon learn what's a norm there. But talking about any general benchmark just doesn't make sense. Therefore, you will not be asked, is it a lot, or like, is it high or is it low? It would be more about comparison. So here we can compare year on year. We see the trend, which is deteriorating liquidity. So regardless of which benchmark we use, we know that the liquidity is getting worse. And I'm not talking catastrophic. I'm just saying that the trend is the company's liquidity is deteriorating.
That doesn't necessarily need to be bad.
Well, I suppose you could have a situation when the company is too liquid. In other words, it doesn't make enough use of its assets, because it's almost like having too much of a good thing. So to answer your question, no, not in all cases would it be bad. Yet, having said that, I think it's a relatively unusual situation when the company has too much of a liquidity. So in most cases, it would be negative.
Not become a high liquidity.
It's better to have high liquidity. Yes. In a general case, yes. In a general case, yes. So unless the company is not making enough use of its resources, in which case, as I've said, a little bit less liquidity could be a good thing. Unless that's the case, otherwise high liquidity is good, because it means that the company will be cash rich rather than poor, and it would be much less likely to not be able to meet its obligation, if you think about it. Because cash is excellent. Cash is the most liquid. Short-term investments are quite good too. You can sell them quickly, convert them to cash, and then if you quickly need to buy something or pay off your obligations, that's a source for you. Then debtors, you usually collect them within 30 to 60 days, and then inventory. But again, it depends. I think for some companies, for example, a food company, especially if you're talking about fresh produce, you won't have inventory sitting on the company's shelves for weeks, because fresh produce you need to keep the stock current. So that would likely be more liquid than your accounts receivables. If you're selling, for example, computers or furniture, then your inventory will be probably less liquid. Yeah? Now, your favorite topic, time value of money. Am I right? That's your favorite topic.
I don't like it.
I like this.
I'm joking. I think it's not only not favorite topic, but there have been some
like this.
issues with it. But it's really pretty straightforward once you understand the principle. So raise your hand if you still don't understand the principle of time value of money. Okay, either everyone understands or no one wants to confess. But in any case, let's make sure that we're really clear. So, how do we appraise any project, or how do we value any security? This is the beauty is that this one topic and technique is then applied across various topics in financial management. So what we're trying to do here is to bring various events that happen in different points in time in regards to our financial inflows and outflows to one common base at which we can compare them. So we have spent some money today, and then we will receive some money in 1 year. We will receive some money in 3 years and in 5 years. How do we decide whether this is a good proposition or not? It's very difficult to decide, is it a good idea for me to spend £10,000 today and then receive £500 every year forever? If I ask you a question just like that and you try to solve it in your head, it's very difficult. You can't answer this question. What do you need to be able to answer this question? Interest rate allows us to do...
Calculate the present value of the money.
Yeah. And what's the present value? That's an example of a short question you can be asked. So you better try. Yeah, by the way, as an exam preparation technique, just look at various slides and various textbook chapters that are relevant to our module, and you come across some concept. So on the spot, make yourself write a definition. Just write. So you're reading about present value, ask yourself, what's present value? Write it into sentences. You're reading about liquidity ratio, ask yourself, what's liquidity ratio? Write a definition. You are reading about a warrant, ask yourself, what's a warrant? Write a definition, and so on. And try doing it without looking to a textbook at first. So your answer is likely it will be bad initially, but then you will immediately understand what you still need to look up and learn, and it will be a good practice. And inevitably, sometimes you will revise, but you can't revise everything. So chances are you'll get something you haven't practiced writing a definition for. Therefore, you need to actually develop a skill. Okay, you understand roughly what it is. You don't remember the exact definition. Try to describe it concisely. So as long as it makes sense, it's clear, it doesn't have to be like exact textbook definition. but being able to describe it in your own words is very important. So coming back to my question, what's the present value?
The value of
The total value of the investment company
at the moment.
and the
One here.
future value of the investment, how much value? If I am right, probably the future value. the
Well,
present
more or less, yes.
More-
But basically, yes, this is the value in the present terms of the cash flows that we are going to receive in different points in time. Yeah, that's what it is. So again, one of the examples we looked at earlier, we have some cash outflows and some cash flows in different points in time. So today we need to spend 2,000 pounds, but then we will be getting 600 every year for several years. Does anyone have an idea of how we would calculate the present value of this
What the formula
stream of cash flow?
future value is the formula.
Yeah.
Future value minus
Future value
1
of
plus
the
the
year.
interest.
I'm asking about the present value.
Oh,
Future value.
So where is the future value here?
It depends on which year you want it.
you have to draw a timeline.
Well, here,
Year one.
aside from the first row, all other things are components of the future value, right?
Yeah.
It's just the future value that we receive at different points in time. What do we need to do with them in order to bring them to the present moment?
Add them all together.
Just add them. That's it.
No, divided by the interest in the power of the years.
And how do we call this process of dividing it over this whatever?
Present value of each year.
Discounting.
Discounting.
Discounting is the process of using this interest rate and the appropriate number of years to bring our future cash flow to the present moment. So that's the formula for the future value, which I'm sure you recognize very well by now. So that's when we want to, and how do you call the process actually of
Doing it the other way.
doing it the other way around?
Compounding.
Compounding. Yeah? Everyone clear on that? So when we're trying to get to the future value from the present value, we're doing the compounding. That's adding the interest rate raised to the right power to see how much interest those money will have done by that point in time.
And the number of the years comes is, for example, 1 plus interest rate, and the number of years, 3 years, 2 is will be that.
Yeah? Yeah? It just depends on our time horizon. So that's sorry. So this stream of cash we have just looked, if we want to discount it, that's how we do that. Is everyone really clear for
Yes.
why we have to raise to a different power each time?
Yes. Yes.
So why? Could you just say for the benefit of your colleagues?
Oh no. For the number of years.
Every year.
Yeah. So the further some cash flow is away, the more we have to discount it.
But the future value has been decreased from 0 1 year 1 to year 4. If I am right.
Because you're discounting.
Well, that's
Over years.
because the further you are into the future, the less valuable it is now. And why is that? Again, we've discussed it, and that's another good question for you to practice. Why is it that the further away is the expected payout, the less valuable it is to us?
Inflation.
Inflation.
Interest. No,
In-
sorry.
in-
No.
What do you mean by interest?
You might not get it.
You might not get it, so risk. Okay. Inflation, risk. What else?
What was the question?
And the interest you pay on
The
it.
question is, why is it that the further away is an expected payout, the less valuable it is to us?
That's
So
it.
that just in terms of cash value or any.
Well, yes, since this subject is about finance, we generally talk about money. Here.
And building and expenses and depreciation.
What about the depreciation?
For example, we are investing in a property or machinery or something. That's the present value, but the future value is going to be decreased because of the depreciation, because of that machine has been used for production.
I'm not sure it's an entirely relevant example. No, it's generally about as people were rightly saying, it's about inflation, it's about risk, and also it's about the inconvenience of foregoing consumption now or using it for something else. Could you keep it down?
Yeah.
You'll remember that we will be using timeline, and that's what I would recommend when you're trying to tackle any problem that involves discounting or compounding, just because it makes it a bit easier to understand what's going on here. Now, some people asked me to go over NPV again today, which I'm very happy to do. But I'd like to hear from you. How do we use the NPV to evaluate an investment project? What is NPV?
Net present value.
Okay, I'm going back to my
Present value
question.
for
How do we
outflows.
use it?
If it's over 0, then that's profit, and if it's less than 0, is loss.
If it's over 0, then what?
Profit? Yeah, we go for it. That's
Yes,
it.
we use it as a decision criteria. Yeah.
More than 0 in private projects.
Sorry?
I said it is greater than 1 in private projects.
Not 1, but 0.
0.
So, okay, NPV is net present value, but what does it mean?
How? It's cost going out of the benefit.
Sorry, two people talking simultaneously. Agnieszka, what did you try to say?
We try to discount the future value of the future cost with the current, actually compare this, how much will it cost us now, and it is
Outflows
Another
and
example,
inflows.
another candidate for short definition questions. Yeah, what is net present value?
That's
It's-
all,
it's
the total
not-
of outflows and inflows.
with the future cost.
Yes,
Values.
it compares. Yes, net present value is the sum of the present values of all project inflows and outflows. So let's forget about the future. Let's think in the present. So all the project is happening now. Yeah. So right now I need to buy some eggs, some flour, some sugar. Then I bake a pie, and I go and sell it. Yeah.
Money goes
So
out.
that's my project. I calculate how much all these products will cost me. I also probably want to include the depreciation of my oven and the cost of my time. So I won't be teaching, I won't be doing anything else at this time. So I need to also calculate my time. And then I do some market research. I ask all my neighbors for how much they want to buy my baking. So the result is I will be able to sell it for £50, and the cost of all the components and the time that went into it is £70. Should I bake it? No. Why? Because I'm making a loss, right? Okay. Exactly. Now, it's exactly the same question, but all those things are now not necessarily happening simultaneously. So I have done all this work now, but my neighbors will only pay me in a year. That's the strange deal we're on. You see, I have to do the baking today, but get paid in a year. So it's the same principle, it's just now the calculation needs to be adjusted a bit. So I'm thinking, okay, so I will get paid in a year, but actually, if I had this money now and I would put it in a bank, I would probably earn 2% in it. So I then need to discount those money by those 2%. That will make the comparison fair, because the costs are happening today, in today's term. My neighbors are paying me in a year, and that's not the same. The pound in a year is not the same as the pound today. So I need to bring it into today's moment. That's why I'm discounting. So in other words, net present value is just the calculation of the overall result of the project, but with time taken into account. That's all there is. Therefore, it's very easy, and therefore the decision rule is more than 0 and not more than 1, because if it were my first example of a project all happening simultaneously, the decision rule would be different from 0 or not, right? If my costs are less than what I'm getting, then I should be doing that. If they're more, then I shouldn't. So it's exactly the same principle. Yeah. So this rule is useful for decision making because it can decide us to accept or reject. Now, a particular problem or a particular variety of the problem when you are getting some cash flows is a perpetuity. Again, someone asked me to go over it, so let's just make sure we really understand. Again, it's very simple. It's just that instead of...
excuse me.
Yes.
I'm just looking at what you wrote here. It's accepting or rejecting the project. Accepting those projects with positive NPV.
Yeah.
And a project can be positive even if it's 0.
No.
Sorry, could you repeat that?
From the statement I have just saw you, you say accept those projects with positive NPV.
Yeah.
Because accepting them is equivalent to receiving the NPV in cash today.
Yeah.
So what I'm saying is that if you have a project and you can have 0.00 something 1, that's a positive NPV. So,
Well, whether you should do it or not.
yeah.
Well, it's a borderline case, basically. It's a borderline case, but if it's just faintly positive, you could still do it. But then, of course, if you have an alternative project where you can get more, then you would choose the project with the positive NPV. It's not very frequent that you just have one project in mind. Even if there is only one project as such, when you are building something or creating something, there is always an alternative of putting the money in a bank or lending them to a friend or something like this. So in practice, you are usually thinking about several projects, right? And therefore, if you have something just barely positive, then you would probably just pick another one, right? Okay, coming back to the perpetuity, perpetuity is the stream of cash that doesn't have any end date. Again, we have looked at the examples, but could you remember any such stream of cash that you just keep receiving?
Retirement.
Huh?
Events organizing. Pension.
Pension? Yep. Anything else?
Lottery.
You get that every
Can do.
Dividends as well, and hence the dividend discount model, at which we will look later as well. But again, the principle here is we are trying to value whatever stream of cash that we are going to receive, and we're trying to bring it to the present moment. And the formula here is very, very simple. We just take this recurring stream of cash and we apply the discount rate. Then we can, as a variation, we can have a growing perpetuity. So again, dividend is a good example here, but because let's say I'm telling you, I'm gonna pay you the dividend of £3 per share. Every year, I'm not planning to stop, so for as long as is feasible, but not only is that my promise, I also promise that I will be increasing my dividend by 2% every year, right? And this is when you would apply this formula, because here you also have a growth rate.
This is cash over the interest rate minus growth, right?
Yes, yes. Cash is in monetary terms. Your interest rate here should be in decimals. So you need to transfer your percentages into decimals. Again, another request was to cover internal rate of return. So let's go over this one to make sure we understand what it is. So an internal rate of return, from the point of view of how we're calculating it, is the rate which sets our net present value to 0. In practice, how do we, why do we want to use it? We may want to use it if we need to discover how profitable our project is in percentages, as opposed to in dollars. Why would you want to do that? Well, if you have information in such a way that the decision-making process will be easiest if you are comparing percentages. So let's say you have a project and you're wondering whether you should do it or not. You have an alternative project and you know that you will earn 6% of it. How do you decide? Well, one of the ways is to figure out what will be the return on this project you have in mind and compare it with the 6%. So internal rate of return is just another tool in your decision-making toolkit. So net present value is sort of more universal. So probably it would be the choice number 1. But in some cases, internal rate of return will be more handy for you. We will have a problem in the seminar dedicated to internal rate of return when you will have again a chance to practice. So I would really urge you all to attend the seminars today. I will put put it on the blackboard, yes. You can't come to the seminar. Okay. But are you okay with IRR and other topics? Okay. Again, we have looked at this example before. As I've said, I'm not really introducing new material today, but let's just have another look to see why we would want and how to apply the IRR. So we have here an entrepreneur who finished her MBA and she wants to invest in her business and requires 1 million. After that, she will generate some cash flow which will grow at 4% per year. What's the internal rate of this opportunity? So if she is offering you to take this project, that would be the right question to ask, right? Because you know how much you are getting, but that may be not the information you need to make your decision. Because you know, my alternative is to put money in the bank, and the bank offers me 3%. Then knowing in absolute terms what it's generating may not be the most relevant information. If you have the alternative opportunity which is formulated in percentages, then you also want to know the answer in percentages. What's the percentage of return it's generating? That's why you would want to calculate the IRR. Here again, you would be drawing the timeline. So you spend the money today, then you get 100,000 in 1 year, and it then grows with 4% per year into infinity. We are applying the formula for the perpetuity with growth that we've seen a couple of slides before. But on the other side of the equation, we put the cash outflow. Or, as I've said, that's the rate which sets the NPV to 0. Because if you minus that from another side of the equation, you will get 0, right? So that's when your cash inflows equal to your cash outflows, and you are solving for the interest rate, that will do just that. So you've solved it, and the result is that you will get 14% on this investment. If you're offered to put money in the bank at 3%, then you know you should take it. So if you have, the problem with internal rate of return is that in many cases it's tricky to solve. It's not by accident that the previous example was looking at the perpetuity, which is a really simple formula. But if you have varying cash flows and you need to discount each of them individually, then solving for that analytically will not be an option. That's another reason why net present value is used more than the internal rate of return for investment appraisal. Here, the decision criteria is if the cost of capital or the alternative opportunity is more than the internal rate of return, you then reject this project. If it's less, you accept. In the previous example we've looked at, the internal rate of return is more because the alternative opportunity, as I said, is put money in the bank at 3%, but here we can get 15. Therefore, we take this project. Oh, there is a typo in the typing. But that should say share valuation. The valuation of shares, there are two ways, and they are quite fundamentally different from each other. I mean, there are variations, but all of them really come down to two methods. Either you view the value of shares as the present value of the stream of cash flows that you're hoping to generate from it, or you say, oh, forget it, it's too difficult to try to estimate it, and you then just look at their comparable companies and you are valuing it on the basis of comparables. And then all the rest are just various variations to this principle. The same is actually true for bonds. When we were talking about the valuation of bonds, it's exactly the same. So what is differing from one security to another is the type and timing of cash flows that we're going to receive. That's really the main difference, and that then drives the difference in the formulas and approaches. But as I said, the beauty of the time value of money and discounting and present value is that it fits into all topics, because that's what it really comes down to. Pretty much almost everything we've done, finding the present value of future cash flows, and that's what the valuation is based on. So let's look at first at the simpler case, again the one we have looked at before, and that's comparables. So we have price to earning ratios for various companies which we consider peers. And as we've been discussing, one of the important practical problems is to establish peers. So at first let's take a simple case such as, for example, Tesco. I think many of you like Tesco because people were writing about that, and there were other supermarkets as well. So I think that's the industry this class tends to favor. What would be the peers for Tesco? Sainsbury's, yeah.
Would Asda be one?
Hmm?
Would Asda be a
Yeah.
pair?
Asda, yeah, I think it
Even though
would.
it's owned by
Morrison's.
Walmart.
Morrison's.
Morrison's, yeah, but Asda, no.
Why?
Different business.
Yeah.
No, it's
Lidl,
not.
probably less so.
Owned by Walmart.
Waitrose,
Marks and Spencer. more or
yes,
less.
yes, more or less. It's a bit different, but I think we could consider
Yeah,
it.
Mark Spencer.
What do we get?
Yeah. So we established a group of like 5 or 6 peers for this company, and we then see what their PE ratios are. Again, you could debate whether Waitrose should be in the peer group or not, whether Lidl should be there or not, but you get the idea. You try to identify companies which are doing similar things, which are also quite large, that have many branches across the country, and you say that's the peer group. And then you collect the information for that. But okay, for Tesco it would be probably a bit less of an issue because it's a traded company. You can see the share price. Yes, you can try to figure out, is it undervalued, is it overvalued, but there is an objective indicator, the share price. The case when it would be really important to do this kind of analysis is when you are looking at a private company and you have no way of establishing what it's worth other than trying to look at some of its peers for which you may have this information, right? So here you're not really making any assumptions about what the cash flows of this company will be, what its prospects are. You're just saying, okay, well, if that's true for its peers, they're sufficiently similar for me to be thinking that roughly the same principle should apply to this company. So you then calculate the average of the PE ratios for this company, and in this case it's 21.2. That's times, right? So it's not percentages or it's not dollars, it's times. Because I think there was some confusion about what are the units in which PE ratio is calculated. There are no units because prices in monetary value, earnings are also in monetary, right? So you get rid of but you have pounds in numerator, pounds in denominator, and you cancel each other out. So you just get times. So then what do you do with it? Well, you have the earnings of the companies in question. So even if it's a private company, you can figure out how much profit it produced and divide it by the number of shares. Then you take this average coefficient and you multiply the two, and hence you're getting your price, which you think is a more or less fair valuation of the company in question. Yeah? Everyone is clear on this principle, how we apply PE ratio to value the company. This is what you, I think if you would be doing the share valuation in practice, especially as I said of a private company, you would use this kind of method in most cases rather than the cash flow based methods. For shares, predicting cash flows is particularly difficult and almost hopeless matter. For bonds, it's much easier. Why? Why is it easier to predict cash flows for bonds than for shares?
So a fixed interest.
Yes, first of all, there is a fixed interest, so you know what it would be paying. And what else is fixed then? The principal, right? So the bond has a principal, then that's the main amount that basically we have borrowed as the bond issuer that we need to repay. So as we discussed, bond operate in a very similar way to a loan. It's just that this is debt distributed across many investors. Rather than having one loan and one big lender, such as a bank, you are taking this loan and distributing across many people. But otherwise, it's the same approach. So you have the principal amount, that's what you need to repay at the end of the term. You know how much there is, and you also know how much interest you will be getting. So there isn't that much uncertainty. Yes, there is some risk involved. Will they pay at all? How are they doing? But nevertheless, assuming that the company doesn't go bust, you know what you're getting. And in those conditions, applying the principle of discounted cash flow is easier. With stocks, in many cases, you have no idea what it's going to be. There are two main sources of payout for shares, right? If we have invested in shares, we can make our money in two main ways. What are these ways? What are these sources? How can we make money if we invested in shares?
Growth. Growth.
Sorry, could you repeat that?
Dividends.
Dividends, yeah. Dividends and the capital gain. So all we need to forecast is first the dividend and second the future share price. And if anyone can do it reliably enough, then one would be Warren Buffett or someone like that, which is a notoriously difficult task. That's really the problem with it. So depending on our horizon, our investment horizon, the formula then gets modified. And again, I would urge you to try to understand the principle more than try to memorize a bunch of various formulas. If you can understand the principle, then you don't need to remember it. And the principle is that the price of share is again the present value of all cash flows that we can receive in connection with it. And as we've said, those cash flows can be dividends or capital gains. So if, for example, you bought this share in order to never sell it again, then you don't need to worry about the capital gain. That part of the formula where you have a price at a later date becomes pretty irrelevant for you because you don't care. You are not going to get this cash flow. Then all you need to do is estimate the stream of dividends. And then again, good luck if you try to estimate them as varying numbers every year. That's really very difficult. But you can do that. If you think you have enough information, you can forecast the dividends as many years into the future as is relevant to you, and then discount them at a particular discount rate. But because it's so problematic, you then get simplification. So what I'm trying to say here is that we don't really have many different formulas here connected with the share valuation. It's just the modification where the principle is always the same. So we have just considered, we have just simplified it at first by deciding I'm going to call it forever, therefore I'm not going to worry about PN, if that's your case. If not, you need to worry about it. Then you are trying to forecast for how much you will sell it and again discount it back into the present. Then we decided, okay, forget it, I'm not going to be able to assess the specific dividends every year. So I will just assume that dividend growth grows at a constant rate. And then we arrive back at the formula of the growing perpetuity, right? Again, the same principle here still. We are calculating the present value of the future cash flows. It's just that we have different ways of conceptualizing those future cash flows, where they come from. So here we are considering a case where the cash flow consists of the constant stream of dividend but growing at a constant rate. If we think that the dividend will be flat into the future, then we just get rid of G here. There is no G. There is just dividend over the discount rate. And that's your formula for a perpetuity, not growing perpetuity. Does it make sense? Can you see how we apply the same principle all the time? Present value of future cash flows, and then we look at them in different ways. Yeah?
Present value. Present value.
Yes, P0 is the price we want to pay today. So we're just asking ourselves, how much is it worth to us, this stock, and then you're trying to figure out what will be the cash flows associated with it. Another topic I wanted to cover quickly is to remind you how we compute historical returns. So we have returns, yearly returns for a particular security. Let's say the stock, and then we plot them. So how does this distribution is created? Well, here we basically have that 60 times we had the return of just over 0, so something like 3%. So if we look at the long stream of numbers representing the historical returns, yeah? So let's say in 1960 it was 3%, we counted, 1. In 1962, 3% again, 2, and we build this graph. So every time a particular return is repeated, you put it there. So you basically calculate the number of times each return appears in your time series that you're looking at. And that's how you're building the empirical distribution. And as we've discussed, this distribution has much less variability when we're talking about some reliable asset classes such as treasury bills. And you have much more variability if you are looking at small stocks. Here you're just calculating the average. Hands up if you don't understand this formula. Okay. So R bar is just a notation which means that it's an average. Yeah. Then we can have R1, R2, and all the way to RT. These are returns in various years. T is the number of So we summed up all the returns that we had over these years and divided by the number of years. And this is just a short form notation of exactly the same. So the sigma sign means that we need to sum everything. So this is exactly the same as this. This is just a shorter way to record this formula. There is just really nothing complicated about it. It's just a shorter way because you don't want to write out such long formulas every time, right? And then we've been also discussing the concept of variance. You need to try to remember it and most importantly understand. Again, as long as you really understand something, remembering becomes much easier. So if you don't want to learn a lot by heart, try to understand. It really helps. So we've been saying that if in some years we have negative returns and in some years we have positive returns, so in some years we've lost money, in some years we've made money, yeah? If you start just adding those things up, they cancel each other out and you may get something close to zero, which doesn't really show you the true scale of how variable your returns are. Therefore, to get rid of these differences in size, you square them, because a square of any number is a positive number, right? So then you're squaring those returns, and thus you can capture the scale of both negative differences and positive differences. So that's a variance. And then you just take the square root to get rid of this squaring, artificial squaring you've got. And that basically shows you the variability of your returns. So standard deviation is really a variability, and because something which is reliable and consistent, we consider it as low risk, and something that's all over the place and keeps changing, we consider it high risk. Therefore, standard deviation is considered one of the measures of risk, because after all, risk is when things are all over the place, we don't know what's going to happen. Yeah, so it makes sense. But this is just a summary of the formula. We're applying the right-hand side formulas when we're looking at historical returns. But when we have scenarios such as with 30% probability we will make 10%, and with 20% probability we will lose 5%. Then we need to include those probabilities in the formula where we need to wait. But there will be again a problem in today's problem set. Actually, this one I think is from one of the earliest weeks. All other problems are new that we will cover today. Well, I mean they're similar, but they're new. This particular one, I've included something from one of the weeks I'd like to ask you whether there is something in particular you would like me to cover, because I think we won't go through everything. So do we just carry on for 10 minutes and then we stop where we stop, or there are some topics you particularly want to go over? You can ask about anything in the whole of the module, not even necessarily that's what's on your slide.
I was looking at lecture 12 and personality theory.
Personality theory.
Behavior.
There was prospect.
Oh, you mean
There was behavioral finance, non-behavioral finance, and there's personality theory. But you didn't explain it on the
I did.
under the PowerPoint, you did not talk about it. But you have it as one of your agenda.
Fair enough. Okay.
I was like, I don't know where it came from.
Don't worry, there will be no questions on personality theory, but I'm happy to talk about it. It's just that when we talk about the human behavior and we talk about the influence of